Hey everyone, and welcome back to the channel. Today we're diving deep into a stock that seems to be on everyone's mind, or at least always comes up in the comments section. SoFi Technologies, ticker symbol SoFi. Now, if you're like me, you've probably seen the headlines. SoFi is a fintech darling, disrupting traditional banking, a growth stock with massive potential. But for every bullish argument, there's a skeptic warning about competition, profitability, and that tricky interest rate environment. So what's the real story here? Is SoFi truly the future of finance, a solid long-term hold, or is it a risky bet that could burn you? Today, we're going to break it all down. We'll explore SoFi's unique business model, its competitive advantages, and the challenges it faces. We'll look at the numbers, the growth drivers, and the potential roadblocks. My goal here isn't to tell you to buy or sell. It's to give you all the information you need to make your own informed decision about whether SoFi fits into your portfolio. This isn't just about reading financial statements. It's about understanding the narrative, the vision, and the execution. So grab a coffee, settle in, because this is going to be a comprehensive look at SoFi stock in 2025. Let's get into it. Segment 1, SoFi's identity, more than just a bank. All right, first things first. We need to understand what SoFi actually is, because it's easy to get confused. They've gone through a pretty big transformation over the years. Many people still think of them primarily as a student loan refi company. And while that was their origin, it's a very outdated view. Today, SoFi is a full-fledged digital bank and a diversified fintech platform. Think of them as building a financial super app. Their pitch is simple. Instead of having your checking account with one bank, your savings with another, your loans somewhere else, and maybe investing with a brokerage, SoFi wants to bring all of that under one roof with a sleek, user-friendly digital interface. They want to be your one-stop shop for all things money. They operate across 3 main segments, and it's crucial to understand these. Lending. This is still a huge part of their business, but it's diversified. Yes, they do student loan refinancing, but they've expanded massively into personal loans, which are often used for debt consolidation, home improvements, or unexpected expenses, and also home loans. These loans are primarily for high-earning, responsible individuals, often referred to as Henrys. High earners, not rich yet. This is their sweet spot, aiming for customers with strong credit scores and high income potential, which theoretically means lower default rates. Financial services. This is where they really become a bank. They offer SoFi checking and savings accounts with competitive interest rates and features like early paycheck access. They have an investment platform for stocks and ETFs, active investing, and even crypto. They also offer credit cards, insurance products, and financial planning tools. This is the super app vision taking shape. All your money needs, managed digitally. Technology platform. And this is the one that often surprises people, but it's incredibly important. SoFi owns 2 key technology platforms, Galileo and Technisys. Galileo is a crucial infrastructure provider that powers the back end for other fintech companies and neobanks. Think of it as the plumbing for companies like Robinhood, Chime, and even some traditional banks that want to offer modern digital services. Technisys, which they acquired a couple of years ago, is a core banking platform, allowing financial institutions to build and manage their accounts. This segment provides a consistent, high-margin revenue stream that's less sensitive to interest rate fluctuations than their lending business. So, when you hear about SoFi, remember it's not just a lender. It's a bank, an investment platform, and a critical technology provider for the broader fintech ecosystem. This diversification is both a strength and a source of complexity when evaluating the stock. It's truly trying to build a new financial infrastructure from the ground up. Segment 2, the bull case. Why investors are excited. Okay, now that we know what SoFi is, let's talk about why so many investors are bullish on this stock. What's the compelling story here? The biggest argument for SoFi is undoubtedly its growth story and user acquisition. Despite a challenging macro environment, SoFi has been consistently adding members and products at an impressive clip. They're not just getting more people onto their platform, they're getting existing members to adopt more of their products. This is key because it means they're successfully cross-selling, getting you to move your checking, your investing, your loans, all to SoFi. This flywheel effect means higher engagement, more data, and ultimately, a higher customer lifetime value. Their national bank charter is another massive differentiator. Acquiring a bank charter was a huge undertaking, but it changed the game. Before, they had to partner with other banks to offer checking and savings accounts and were reliant on third-party funding for their loans. Now, as a regulated bank, they can hold deposits themselves, which provides a much cheaper and more stable source of funding for their lending business. This dramatically improves their net interest margin and allows them to be more competitive on rates. It's a massive competitive moat that many other fintechs simply don't have. Let's talk about profitability. This has been a huge focus for SoFi, and they've actually delivered. After years of operating at a loss, SoFi achieved GAAP profitability in late 2023, and they've been consistently profitable on a GAAP basis ever since, meeting Wall Street's expectations. This is critical for any growth stock to eventually attract institutional investors. It shows the business model can work and that they can scale revenue faster than expenses. The technology platform with Galileo and Technisys is another unsung hero in the bull case. This segment generates high margin, recurring revenue that acts as a ballast to the more cyclical lending business. Even when interest rates are volatile or loan demand fluctuates, the technology segment keeps bringing in solid cash flow. It shows diversification beyond just lending and demonstrates their capability to be a true infrastructure play in fintech. Finally, their target demographic, the Henrys. These are young professionals, often with advanced degrees, high incomes and excellent credit scores, but who might be burdened by student debt or navigating their first big financial decisions. They're tech-savvy, open to digital-first banking, and represent a massive, underserved market that traditional banks often struggle to connect with. SoFi is building products specifically for them, aiming to capture them early and grow with them throughout their financial lives. This is a sticky, high-value customer base. When you put all this together, explosive growth, a valuable bank charter, growing profitability, diversified revenue, and a clear target market, it paints a picture of a company with significant long-term potential. But as with any investment, there are always two sides to the coin. Segment 3, the bear case. What keeps investors up at night? Alright, so the bull case sounds pretty compelling, right? But it's never that simple. Smart investors always look at the potential downsides, the risks that could derail the growth story. Let's dig into the bear case for SoFi. One of the biggest concerns has been and continues to be the interest rate environment. SoFi's lending business, like any bank, is heavily influenced by interest rates. When rates are high, as they have been, it can increase their cost of funds and make it harder to originate new loans at attractive rates for customers. While their bank charter helps them with cheaper deposits, they still operate within the broader macroeconomic context. A prolonged period of high rates or a sharp recession could certainly put pressure on their lending margins and loan growth. Then there's the elephant in the room, competition. SoFi isn't operating in a vacuum. They're battling traditional banks like JP Chase and Bank of America, which have vast resources and customer bases. They're also up against other fintech giants like Chime, Robinhood, Block, Square, and even newer, nimbler startups all vying for that same Henry demographic. The fintech space is incredibly crowded and competitive, and customer acquisition costs can be very high. Can SoFi truly out-innovate, out-market, and out-compete these players over the long term? Credit risk is another constant concern for any lender. While SoFi targets high-quality borrowers, no loan portfolio is completely immune to economic downturns. If a recession hits hard, even Henrys can face job losses or financial stress, potentially leading to higher default rates. Investors will be closely watching their loan loss provisions and delinquency rates. While they've managed credit well so far, any significant uptick could spook the market. The student loan moratorium has also been a wild card. The pause on federal student loan payments during the pandemic significantly impacted SoFi's student loan refinancing business, which was once their bread and butter. While the moratorium has ended, the prolonged pause demonstrated how a single policy decision can dramatically affect a segment of their business. While they've diversified, it's a reminder of potential external shocks. Finally, valuation. Despite pulling back from its all-time highs, SoFi is still often valued as a growth stock, not a traditional bank. This means it often trades at a higher multiple of earnings or revenue than established banks. For some investors, the current valuation might still seem stretched, especially given the competitive landscape and macro risks. They might argue that the potential for growth is already priced in, and any stumble could lead to a significant re-rating of the stock. So, while the growth story is exciting, these are the very real challenges that could temper SoFi's trajectory. It's about weighing these risks against the opportunities. Segment 4. The numbers and what to watch for. Now, let's get down to the brass tacks, the numbers, because ultimately, the narrative has to be backed up by financial performance. When I look at SoFi's earnings reports, a few key metrics always stand out. First, member growth and product growth. We've talked about this, but it's critical. SoFi consistently reports robust quarter-over-quarter and year-over-year growth in both members and the number of products those members are using. This shows their cross-selling strategy is working. The more products per member, the stickier the customer and the higher their lifetime value. You want to see this trend continue upwards. Next, revenue diversification. Look at the breakdown of their revenue by segment: lending, financial services, and technology platform. The bull case relies on the financial services and technology platform segments growing faster and becoming a larger percentage of total revenue. This reduces their reliance on the more volatile lending business. We want to see that shift happening. Net interest margin, NIM. This is a key banking metric. It essentially measures the difference between the interest income they earn on their loans and the interest they pay on deposits. A healthy, growing NIM indicates they're efficiently funding their loans with cheap deposits from their bank charter. This is where the bank charter really pays off. And of course, profitability. Specifically, GAAP net income. They've hit this milestone, and now the expectation is consistent, growing GAAP profitability. Investors will be scrutinizing this quarter after quarter. A stumble here could be very damaging to sentiment. Finally, credit quality metrics. Keep an eye on their delinquency rates and charge-off rates for their loan portfolio. These numbers tell you how well they're managing risk and how their borrowers are performing. Any significant increase could signal stress in their customer base or a loosening of their underwriting standards. So, when the next earnings report comes out, don't just look at the headline numbers. Dive into these specific metrics. They tell the story of whether SoFi is successfully executing its strategy and managing its risks. It's not just about hitting revenue targets. It's about the quality of that revenue and the underlying health of the balance sheet. Segment 5. The future. What's next for SoFi? So, where does SoFi go from here? What are the catalysts and trends that could push it higher or hold it back? One major catalyst could be a shift in the interest rate environment. If the Federal Reserve starts cutting rates, even gradually, it could significantly benefit SoFi's lending business by reducing their cost of funds and potentially stimulating demand for loans. This would likely expand their net interest margin and accelerate growth in their largest segment. Another key area is the continued expansion of their financial services products. Imagine SoFi offering integrated tax preparation, sophisticated AI-driven financial planning tools, or even more robust small business banking solutions. The super app vision isn't complete, and every new product that genuinely adds value strengthens that flywheel effect and increases member stickiness. The scaling of their technology platform is also critical. Galileo and Technisys have massive potential. Winning more enterprise clients, expanding geographically, or developing even more advanced fintech infrastructure solutions could significantly boost their high-margin revenue and cement their position as a behind-the-scenes powerhouse. However, the future isn't guaranteed. Increased regulatory scrutiny on fintechs could always pose a challenge, and the intensifying competition means they have to continuously innovate just to stay ahead. And let's not forget the broader economic picture. A severe recession would test even the strongest financial institutions. Ultimately, SoFi is playing a long game. They're trying to build a truly differentiated, digital-first financial institution for the modern age. It's a massive undertaking, filled with both immense opportunity and significant risk. Video conclusion. So, bringing it all together, is SoFi stock the future of finance, or a risky bet? The answer, as with most things in investing, isn't a simple yes or no. SoFi has demonstrated impressive growth, built a unique diversified business model, and achieved that critical profitability milestone. The bank charter is a huge advantage, and their focus on high-quality members is smart. They are executing on a bold vision for a financial super app. However, the stock still carries considerable risks. Interest rate sensitivity, fierce competition, and the constant need to manage credit quality in a dynamic economy. Its valuation reflects a lot of future growth potential, which means any misstep could be met with harsh investor reaction. For me, it boils down to whether you believe in their ability to continue executing on that super app vision, to grow profitably, and to effectively manage the macro headwinds and competitive pressures. It's not a stock for the faint of heart, but for those who believe in the digital transformation of finance, it certainly offers an intriguing proposition. As always, do your own due diligence. This isn't financial advice, just an in-depth exploration to help you on your investing journey. What are your thoughts on SoFi? Are you bullish, bearish, or just watching from the sidelines? Let me know in the comments below. I always love hearing your perspectives. If you found this video helpful, please hit that like button, subscribe to the channel for more deep dives, and ring that notification bell so you don't miss our next video. Thanks so much for watching, and I'll see you in the next one.